This is a fair value gap, and absolutely everybody's talking about them. But did you know that fair value gaps aren't the only types of imbalances? There are others, like the opening gap and volume imbalances. In this video, we're going to cover the imbalance detector and show you everything that this indicator has to offer your trading. To find this, go to tradingview.com and in the indicators tab, search for imbalance detector and make sure it's by LuxAlgo. This indicator can detect 3 distinct types of imbalances that are going to help you trade. The first one is the classic fair value gap. Fair value gaps are a 3-candle formation where the wicks of the first and third candle don't overlap with each other. The result is an imbalance in price action, which is commonly known as the FVG. Now, typically, all of these imbalances will be filled partially or completely. They can act as your take profit targets, or even as an area of support or resistance. But fair value gaps are just one of the countless types of imbalances. So what are the others? The next one that you should know and this indicator covers are opening gaps. These are imbalances characterized by non-existent activity within a specific price range. Let me explain. The day opening gap is the difference between the closing price of the previous day and the opening price of the current day. Last but not least, we have volume imbalances. Volume imbalances are inefficiencies in markets characterized by 2 adjacent candles with non-overlapping candle bodies, while their wicks do overlap. These imbalances are more commonly found in stocks, futures, forex pairs, and on very low timeframes in cryptocurrency. So go ahead and open up your indicator. In the settings, we have an optional feature that we can turn on that's going to be important. This dashboard shows you information about the imbalances on your chart, namely their frequency of occurrence and their fill percentage. While this info might not be useful to everyone, I certainly find it interesting. But just being aware of these imbalances isn't enough. You need to know how to trade them in real time. So let's go over how that might look. In this example, we can see a downtrending market. You might also notice this gap right here. This is our opening gap. One way we could look to trade this is by waiting for price to fill in the gap before entering a short position. Looking here, we made equal lows, which the market could look to target later. After a while, it finally reached the gap, and now we want to zoom down into a lower time frame to monitor the price action there. Now that we've done that, we want to wait for price to take out a high before we look for a short trade. Then, once we get the sweep, we can look to enter when it closes below the bullish candle, simply setting your stops above the high and aiming for targets lower. But here's a different way to look at it. In this example, we're actually coming from an uptrend, and this is indicated by all of our bullish fair value gaps that are being created. Now that price has tested the most relevant fair value gap, it's starting to move higher. We want to wait again for price to create a new fair value gap to confirm the continuation. And here it did just that. So we could look to set a limit buy in this area to go long, simply setting our stops below the candles here and targeting our levels higher.